Thanks very much. Welcome back to the program. 5 minutes past the hour. Chuck Malamut is here. In the final 10 minutes this hour, we have the Chief Medical Officer of the American Foundation for Suicide Prevention, a very important 10 minutes to close out the hour as well. Chuck Malamut is in the house. Ladies and gentlemen, and this program is presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck. They do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast, subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. Mr. Malamut, good morning to you.
Good morning, Harry.
How you doing, buddy?
I'm doing A-okay. How are you?
Good. Good to see you. A lot going on. Of course, GDP revised downward yet again, but I know at some point you'll be getting to that.
Well, Harry, I don't like starting the our session together on a downer note, so to speak. But I think we can save that for a little bit later if you like, or we can do it later. Talk about it,
and also later we're going to talk about the Fed because there is more smoke that there will be a rate hike before the end of the year, which I've always agreed there'll be one rate hike before the end of the year. The only thing that people disagree on is will it be September or will it be after the election. I happen to be one that believes, and I have a pizza riding on it or a very expensive dinner if I lose. I happen to believe the rate hike will come later. So we'll get into that a little bit later in Chuck's program as well. We're going to take a look at inflation. Is there any? We're going to take a look at the U.S. equity markets. And as usual, Chuck, you're going to open up with a market update.
So, Harry, August, we are certainly in the dog days of summer here. A lot of strategists were of the opinion that we would have a significant amount of volatility during the month as we continue to work through, or the markets continue to work through Brexit as we, ramp up for the election in
By the way, let
November.
me challenge you on that. What markets are working through Brexit? Because that has been a nothing burger.
No, but what is happening? The concern was, Harry, that you would have a significant amount of volatility, over the summer. As the UK worked through, Brexit and what the implications would be with respect to not only their country but Europe and certainly over here in the U.S. So
has it sort of worked out though that we've been insulated from it? It hasn't been any big deal here. That clearly it's been an issue for them.
Harry, it has been an issue for them. But what is happening is that we are starting to see a fair amount of stability in the European markets, and we've had a fairly significant rally off of the lows as we had that vote that went the wrong way, and I think that caught everyone, by surprise. So maybe
Chuck, and I know you're not afraid to be the contrarian at times. Maybe the vote went the right way.
Well, I don't not.
Because that's how I view it.
Well, Harry, I'm not quite certain that the right way is exiting. I'm thinking that the right way would probably been to remain as is, and unfortunately, we're not going to have that answer for several quarters or several years. And the big fear was that there would be other countries, on the heels of this, looking to say, okay, well, the UK did it, so Spain, Portugal, we're going to go for it as well. And
but none of them did.
There's been a lot of discussion, but nothing has really happened as a result of all of the vote back in the early part of the summer.
This just in at 8:07 a.m. I have an email from President Jimmy Carter. I will share that with everyone at 9:35 this morning. Chuck Malamut, back to you, sir.
So, Harry, as we look at last week, on the heels of yesterday, which happened to be a very good day in the markets, and I think caught everyone sort of by surprise. We've been trendless for any of a number of weeks now, and little changed over the last month. Stocks did drift lower a little bit last week. The S&P was down less than 1%, down 0.7%. And the main event was Jackson Hole, was Federal Reserve chairperson Janet Yellen's speech, on Friday where she indicated that rate hikes were looking more likely. I know that you're going. No, I'm not going to say you're going to laugh me out of the studio, but
thank you.
Chances are that you might snicker a little bit when I make this next statement. But there isn't the probability of a September hike is continuing to increase. And what, Harry?
Oh, my pizza's tasting good right now. Pizza.
Harry. And I think what will happen is as we look at the reports for August, at the beginning of September, as far as, August employment, it'll give the Fed the ability to go ahead and potentially, make that move.
Here, I want to ask for permission during the Malamut program to suspend the Malamut program for 30 seconds for Harry to make a comment. Permission granted?
Harry, you're the host. You can do whatever you like.
I appreciate it, but I want to suspend the Malamut program so this is held harmless against my brother Chuck. Democrats do not raise interest rates on other Democrats. There will be no rate increase before November 8th. Back to the Malamut program.
That was not 30 seconds, Harry.
I didn't need 30 seconds.
But that's okay. So
my pizza's tasting good already, though. That I can say during your show.
I'm not going to dispute your comment, but I'm merely
so in other words, you wanted to buy me a pizza then.
Harry,
because you love me.
Harry, I would buy you more than a pizza.
You wanted to buy me a pizza. I love it.
I'll actually buy you an expensive meal if you like. But
yes, let's trade off.
But no, we're not trading off. The bet is the bet.
You said you'd buy me an expensive meal.
Why would
Paul Sandler or Alan Angeloni have a lobster for me right
now?
I'm
sure they do, Harry. And you have a nice credit card to pay for it. And you can go enjoy yourself and take a picture and put it up on Facebook and let me see it.
I might be taking you.
Oh, Harry.
If they raise the interest rate in September, I'll be the first to admit, like Fonzie, that I was
Harry, all I said was that they're increasing the probability of it happening in September. I didn't.
Did you hear that on PBS?
No, I did not. No, Harry. We subscribe to some very, very legit, news services, including
your Hammer Time. Too legit. Guys, I've got the parachute pants on. I'm doing Hammer Time in here right now.
Harry, so let's talk a little bit. All right. So now that you beat that to death, and since we are on the topic of
by the way, what is the percentage chance?
It is now in the mid 20%.
Okay, so
range.
still low shot.
But you have to recognize the fact that we went from zero, relatively quickly, and I think the big concern here that all of us have is that is the Fed looking through rose-colored glasses? What information are they in fact looking at? Because as you mentioned a few minutes ago, if you look at GDP, it was revised lower. The annual rate is now at 1.1%. We were the reading before the revision was at 1.2. Our trade deficit did shrink from 63 to 59 billion in June. Durable goods orders were strong, rising 4.4% in July, and I think the Fed looks at that as well, versus a consensus estimate of 3.7%. So, as they gather the data, I think the conflict is, okay, on one side we have high employment, a la low unemployment.
We have low unemployment. We have a very high participation situation, though.
And we have wages that are continuing to increase and putting pressure, on companies because they're, what is happening because unemployment is decreasing. You have those entering the workforce, their skill sets, might not be what the skill sets were, say, people were looking for work, 6 months or a year ago. So,
see if there's any merit to what I'm going to say. I do want to correct one thing. I said low unemployment rate, which is true, and I said high participation. I meant high lack of participation.
Yeah, that's
rate is what I meant. I knew what I meant, but I didn't say it well. So I just want to, because I'll get email on that. There's not a high participation rate. It's worse than, since the Great Depression. That's all true. But let me ask you if there's any merit to this. I think the Fed desperately wants to raise interest rates because it's very hard for them to be in their position and be wallflowers and to just sit by for a decade of zero to near zero rate environment, and they want to raise interest rates. That's what I think.
Harry, I don't disagree with you. I think for sure. I mean, when you have a GDP at slightly over 1%, it's very, very challenging, for the Fed to go ahead and make that move. And the fact that you have, internationally, a lot of countries with negative interest rates, you sit back and say, as an investor, I'm certainly better off owning U.S. debt than some of the foreign countries. But the problem is that you have, when you're growing at 1.1%, what is the justification to merit that rate increase? So the Fed has been very, very outspoken and very, very transparent.
Wouldn't it be bad if they actually raised rates and the data did not support the move? Because I don't want to see that happen. That's not good.
Well, Harry, if you think about where we were a year ago when the Fed had positioned themselves to, say we're going to increase, and nothing happened, and the data points were pretty good at that point in time to in fact merit the raise. They raise in December. The data that comes out shortly thereafter was subpar. And ultimately, what happened is we got to the end of the year, beginning of this year, the market, had a tantrum, so to speak, and it was we had a sell-off. So, if you take a look, for instance, at what happened Friday, the market was positive, I think, to the extent of 100 plus points. Yellen made her speech in Jackson Hole. The market sold off, and ultimately, between top to bottom for the day, I think there was maybe a 240-point swing. We walked out on Friday. It was, I don't want to call it a non-event, but it was certainly workable, as we got into the weekend. But, Harry, I know that you oftentimes talk about the media and the way the media reports. And,
yes.
And I'm going to criticize, the news feeds that you have here on the national level a little bit. When they make a statement saying, well, the market took a beating, the market, was down significantly.
Yeah, I heard that. I didn't agree with that.
And you say, well, wait a minute, the market, we were down 50 points.
Yeah, I know.
And that to me is certainly not, taking a beating.
It was almost a tabloid report. It
was
terrible.
So I kind of ended up, scratching my head a little bit. And then, but I've heard that now, Harry, on different days with different reporters. So the news
you know what that's called, right? It's called echo chamber.
So the news that they're being fed, I think whoever's doing the writing needs to really take a serious look at what they're writing and why they're writing that.
Right, because if you have an infinitesimal slight drop, you don't report that as some heavy, decline in the market. 18 minutes past the hour. Great opening segment with Chuck. You're listening to Chuck Malamut. He is our exclusive financial advisor for the Hurley in the Morning program. Harry Hurley Family, Hurley in the Morning Charity. And make him yours. I strongly, unconditionally recommend Chuck. He leads the Malamut Group at Morgan Stanley's Northfield office as their managing director. 609-383-2010. We're going to be right back. Don't go away. This portion of our program also brought to us by the official and the exclusive golf club to the Hurley in the Morning program, the Harbor Pines Golf Club, owned by the legendary Gerwick's family. And I almost, with a tear running down my cheek, I say this because it's hard to believe that autumn is right around the corner, but it is. And there are some really neat things that will be happening in Harbor Pines. $49 golf every Monday. That's for the fall, for the seniors. That's going to be a lot of fun for the entire fall season. There'll be Friday night happy hour and lobster dinner still in effect. Sunday night prime rib and salad bar in effect as well. And really wonderful opportunities. HarborPines.com. There's more information on the website. If you're making the Senior Monday reservation, the $49 every Monday rate through the entire fall season, advanced tee time is required. So please do give them a call. There will be a few restrictions from time to time. Maybe they have an event or something that's going on. But for the most part, it will always be there for you on Mondays with rare restrictions, either harborpines.com or 609-927-0006. The happy hour is continuing through the fall as well. And again, to reserve, and reservations are required for the Friday night 9-hole golf special. That's after 4:30 p.m., $25. And then you can pair that with an incredible lobster dinner. Reservation 609-927-0006, extension 19. And if you go to the website harborpines.com, you can visit the entire calendar of events for restaurant closures and any of the things that are going to be happening. Prime Rib Night at Harbor Pines Golf Club, 5 p.m. to closing. That features live music as well. That's a really neat program. Prime Rib with a salad bar and side dishes, $14.95 per person on Sundays. Reservation strongly recommended. Call 609-927-0006, extension 19. Back with Chuck Malamut in 60 seconds. By the way, you're going to be hearing about a product that I personally pay for because I believe in it that much. It really works. We're back 22 minutes past the hour. Chuck, have you completed the market update, or are we still on the market
well,
update?
Harry, I don't know. Market update, Fed increase in rates. Are we done? You tell me.
Well, we're definitely not done the Fed rate increase entirely. Well, I think we're done the Fed rate increase entirely. Let's talk about the GDP growth.
But before we go there, Harry,
Yeah.
let me just comment, because we just talked about this just for a second. It's been pretty amazing. If you look at the volatility, or the lack of volatility now, what has happened over the last 30 days, if you look at the lack of volatility in the U.S. equity markets, it's been the lowest volatility that we've seen in more than 2 decades. And now the expectation is that, is it the summer doldrums, or are a lot of people off? What I find very interesting is the fact, Harry, that in spite of everything, all the rhetoric that we're seeing pretty much on a daily basis, the market has done a very, very good job of just sort of casting that aside, and going and doing its business, so to speak.
I've been impressed about that for the entire past 7.5 plus years. I think it's amazing, actually, how I call it resiliency, how resilient the markets have been. Very mature, very solid, and find a way. What I think markets find a way to do, Chuck, in the free market system, they find a way to play by the rules, whatever the rules are at the given time. And I think markets have done a very good job, even in the midst of poor growth and some other, disadvantageous, indices. The markets have been very solid. And which we're fortunate that that's the case.
There's a lot of concern now as you make all-time highs, and there's sometimes in the respective indices. The concern that the retail investor has is, well, maybe the market is too high right now, and I'll have an opportunity to buy on a dip. I think as we get through next weekend, Harry, and we get into September, the U.S. employment report comes on September 2nd, and I think even though a lot of people won't be focused, it'll be off still for the summer, I would expect maybe a little bit of volatility if the report doesn't go as expectations.
I couldn't agree more. And let me ask you how big a deal this GDP thing is, that we are either at zero to fractional to no more than like 1% GDP, going on now for almost 8 years. I have to believe at some point this anemic gross domestic product becomes a real problem, and we have to find a way to get back to more robust 3% and beyond.
Harry, it's not difficult. Unfortunately, what has to happen is that, as much as you care for our government, they have to keep their hands out of your pocket. Mm-hmm. And once that happens, I think you're going to see growth in back in that mid 2s, low 3s levels, and it's going to take some time to get there. But there's just it's like you're holding you're at a race, you're on a jockey on a horse, and you have and you have this exceptional beast that wants to run, and all you're doing is, you're doing your best, to hold that animal back because you have so much more ground to cover until you get to the finish line. And
cash money.
Kind of reminds me of that, so to speak.
So, Chuck, in terms of, and we don't get into politics on your show, but there is something very real right now that's going on, and it's not getting a lot of publicity at all. I think maybe as we get into the fall campaign, the conventional sort of wisdom over the years that the campaigns begin in earnest after Labor Day. This certainly has been going on, almost nonstop since the last election cycle of 2012. So it's played a lot differently in modern times than it used to be. But having said that, sort of as a preamble, one candidate has a crazy number of tax rates, one of them going all the way up to like 43%. The other candidate has 3 very simple tax rates. I think at some point people are going to start to pay attention to that.
Harry, I don't disagree with you, but you have to remember that what percentage of the Americans don't pay any taxes?
Almost half.
So when you kind of put that into perspective, it doesn't really much matter if you have 3 tax rates, or 30 tax rates.
And let me double down on that, because I totally agree with that, and it was a brilliant observation, sort of a twist I wasn't ready for. But having heard you say it, not only that, how about the fact that if half the country has no skin in the game, they don't care how high the taxes are on the makers? No,
because
and in fact they will vote for them to be higher.
The higher tax on the makers, the more the takers receive. So we have to get.
That's sort of the belly of the beast of what you just said.
We have to get out of that, and we have to be able to create good quality jobs. That give you the opportunity for advancement, where you're encouraged to go to work rather than discouraged.
We don't talk about this much on your show, but again, it's not politics, it is finance. I think if we had policies in place that it would encourage a lot of money that is purposefully taken out of this country, and if we gave people incentives to bring that money back home, that could be very helpful to our economy, Chuck.
Well, Harry, your point is very well taken, and what I found very interesting this morning, and I'm a little disappointed in the fact that you haven't said anything about this, because you're focused
that's why you're here
on other things. What is happening is that Apple, all of a sudden they owe Ireland $14.5 billion thanks to an EU ruling which came out earlier today. As a result of that ruling, Apple stock is down about earlier it was down about 1.5% to maybe 2%. So maybe there is cause now to convince these companies to bring the money back into the U.S.
Excellent point, Chuck. We're going to take a brief time out. It's 30 minutes past the hour. You're listening to Chuck Malamut, the official financial advisor to the Hurley in the Morning program. I'm going to share an email question that I've received that I totally disagree with. Chuck might agree with it. I don't agree with it. It's a good friend, but I think he's wrong. Good friend writes the program, I disagree. The market has been level because the government bailed them out 8 years ago. I think corporations have been threatened by the government, and the government has taken over companies, plus the IRS can be sent to threaten your company. So I agree with a lot of that, but I don't totally agree with who the government bailed out. I think that, and I don't think that had much to do with the growth that we've seen in the past 7.5 years. That's happened in spite of the government, not because of the government creating it. And then all you have to do is look at the auto industry. The people that took the bailout did worse than people who did not take the bailout, because the people that took the bailout, they were hamstrung in many ways. I think the question at the beginning is flawed, and then I think the point made at the end is absolutely correct. So I'll break it into thirds. I totally disagree with the first third of this, and I agree with the second and the third parts of it. More with Chuck Malamut in just 2 minutes. Don't go away. It's Early in the Morning with our regular Tuesday morning, 8 o'clock, financial extraordinaire, Chuck Malamut. And again, for all of your financial planning needs, turn to Chuck and his team, the Malamut Group. They're right here locally in Northfield, 609-383-2010, the phone number to call for all of your financial planning needs. We're back 33 minutes past the hour with Chuck Malamut. Make him your official financial advisor. You just simply proclaim it. Dial 609-383-2010 and make an appointment. You'll sit down and you'll understand why Chuck and his team, they've perfected their concept of total asset management coupled with the all-important asset allocation. So we've touched on the market. Oh, let me throw this question. Some of it is I totally disagree with. Some of it I think is on point. So, and you know this person, but I'm going to protect the innocent. A good friend of the program, good friend of me, and you know this person very well too, Chuck, wrote that they disagree with what we've been talking about because they believe the market has been level. And I don't say it's level. The market is up. But this has been level because the government bailed them out 8 years ago. The government bailed out certain banks, but we're talking about companies that are performing for the past 7.5 years to why these indices are at record levels. I think the premise there is not correct.
Harry, if you go back and look, in 2008 and 2009, obviously the world was a lot different then than it is now. There have been a number of enactments of new laws, including Dodd-Frank, which make it very, very challenging for financials. And in particularly, like if you look at the mortgage world, it's been turned completely upside down for a lot of financials and companies that are financially speaking, your big banks, your brokerages to make money. Now, what happens is if you kind of look at year-to-date performance, the going into yesterday, the S&P was up almost 7.5%. I'm sorry, 7.6%. Trailing 12 months up 14. But then when you Harry, when you break out the respective sectors, telecom, energy, utilities, the top performers, anywhere from 15 to 18%. The laggards, consumer discretionary, healthcare, and the worst performer in the S&P, the sector is financials, just slightly up 2%. So if there is a rate hike, and you've seen some shifting in the marketplace, over the last several weeks, where financials are starting to get a fair amount of attention, and that's the result of the Fed potentially making this move. But I'm going to disagree with the listener that wrote in because back in 2008 and 2009, I will agree with you that and agree with the question and the fact that if the Fed didn't and the government didn't come in and help, we would be looking at a very, very dire financial situation. And I think
we were going to collapse, correct?
Yeah, and there was obviously at the time there was a lot of anxiety. I mean, you had Bear Stearns go out in the spring, followed by that fateful weekend where Lehman went down, and then you had the mergers or the buyouts. Bank of America bought out, Merrill Lynch, and then the beat goes on, and there was a lot of distress in the marketplace.
Wouldn't it have been something to be a fly on the wall of Hank Paulson and all these people at that time when they were deciding who would be the winners and who would be the losers? Because obviously Lehman Brothers probably figured out, why aren't we getting our bailout? Why aren't we getting rescued? And other, they did pick winners.
Well, look, there was, you go back, there were a lot of documentaries, there's movies, there's books.
I enjoyed the movie.
So when I think it was Too Big to Fail, as you're referring to, correct?
Too Big to Fail.
And a lot of that did in fact happen. But now, I think what has happened, all the TARP money got paid back relatively quickly.
True.
We right-sized the ship. The world is different now. Financials still are challenged, from a profitability perspective because of all the ongoing compliance that we live through on a day-to-day basis. And
maybe because of what happened, it's over the top.
Well, yeah. Look, the pendulum swung. You went from far left to far right, and you didn't have any opportunity to stop in the middle.
Is it swinging back to the middle, though?
It's not.
There you go.
No. So what is happening now, and I think that's part and parcel as to why GDP is where it is today. Because it's so very, very. It's onerous on on the owner, the operator to produce certain documents and be in compliance, and you spend, I think, way too much time on compliance and less time on operating your businesses. And so the end result is, I think, is what you have, what you have today.
And then the cop out, the easy answer, and I'm not saying you do it because you do not, but the cop out that we're getting, from the government is basically it's a new normal. In other words, we have to accept this. I reject that.
Harry, I don't think that's acceptable.
Can't be.
The fact of the matter is, we've had way too many years with subpar growth. And it's a matter of breaking out, so to speak, and getting back to growing at what we'll call more normalized levels.
And Chuck, I don't think this is an accurate statement, but I'm going to throw it out just as a talking point. Is our past 10 years anything in comparison to the lost decade in Japan?
No, Harry, I don't think we're close to that. I think that country just suffered immeasurably and went absolutely nowhere. I mean, as indicative in their equity markets. Now what has happened? It's been a different case in point here. I mean, if you take a look at the S&P 500, where we were trading at that 666 level back on, I think it was March. If my memory serves me correctly, it was March the 6th of 2000, March 6th or March 9th of 2009, and take a look at the progress that we've made ever since then. So there's been a lot of good that's come out of it, but I think unfortunately, along the way, the retail investor, the climate has changed dramatically, and we lost just so many investors. And the millenniums are looking at the equity markets a little bit differently than the way you and I and your listeners look at the equity markets.
Chuck, for listeners who want to know if quantitative easing worked in your estimation, and you've talked about QE1, QE2, would there be another round of quantitative easing? Do you think that was effective? Did that have a positive impact?
Harry, I think without QE, we would have no growth. We would have negative growth, and so QE was important. You're seeing it now in Europe, where they're going through, and the bond buyback program that is in place over there. So I think QE is important, but wouldn't it be nice if we could just operate without it?
Because we always did.
Yeah, so chances are, as you kind of get to the end of the year, beginning of next, I mean, maybe the book gets rewritten, and then you're in a better position to be more, to grow the economy.
Yeah,
so to
I
speak.
think the answer to that has to be we have to get off of that because it cannot be a permanent solution. There's no way that artificial stimulation in a free market economy is ever going to win if you can't turn that spigot off and have created sound, policies where the free market itself will grow, organically. I mean, this is what we've always been able to do.
Harry, if you take, let's kind of shift gears here for a second, because we've talked about for years of the fact that where are we with inflation? And
do we have inflation?
We have inflation, and I think what's happening is that inflation for a lot of years has been sort of a non-factor, while economic growth levels were highly uncertain. We just kind of chatted about. So as we kind of get into the future, we expect a number of questions over the level of inflation, and it's going to become more prominent as it does in fact move higher. I mean, think about it. You go to buy goods and services, you're paying more now for the most part on most goods and services than you did, say, 3 to 5 years ago.
And correct me if I'm wrong, wages have not kept up.
No, they have not kept up. It's been, there's been discussion that of late in the last 6 months, wages have increased, but not at the levels of inflation. I think what happens is that when you look at how inflation is being reported, is it really a fair number? And we all know that it's not.
Chuck, we have about 3 or so minutes, maybe a little more, even 3.5 minutes left in your program. Definitely want to talk about U.S. equity markets. Is there a change in leadership?
Yeah, there is a change in leadership at this point, and we know, Harry. The broad markets are pretty much little changed since the post-Brexit fallout. Market internals have shifted fairly dramatically. Specifically more defensive, yield-generating sectors have faltered somewhat. Remember the key to buy stocks with big dividends, while economically sensitive cyclical areas have outperformed. So we think that trend, Harry, is going to continue, especially since it appears that yield-oriented segments might be overvalued. So if you take a look, for instance, at the best performers year to date, and they've been pretty consistent. It's been utilities, telecom, and energy. A lot of dividend plays in those particular sectors. But what is happening now, the performance year to date is not as high in those sectors as it was, say 2-3 months ago. And you're starting to see some shifts into other sectors within the marketplace.
Chuck, in a couple of minutes that we have, because we haven't talked local in a number of Malamut shows, I want to get your observations, summer 2016 in Atlantic City. I know you pay attention. Obviously, we're going out with a bang with a trio of concerts that haven't even happened yet, right before and right into Labor Day. Miss America Parade, Miss America Pageant. We just had the Air Show, had the other, Buffett concert. They've added a fifth concert with the R&B and, Belle Biv DeVoe and Vogue. That's been added, and that's a genre that hasn't happened in the Atlantic City Beach concerts. That's a free concert, by the way. But let's get your take on summer 2016.
I think, Harry, it's, if you take a look at the room inventory and the parking inventory, it's obviously down significantly, and that has caused a fair amount of gridlock in town. And demand for rooms. And I'll give you a perfect example. A friend called me. You would appreciate this coming, your days in the hospitality business. About 48 hours on a Thursday prior, looking for a room. This past Thursday, they called looking for a room on Saturday. And I went and, I didn't think it was appropriate to really call any of the people that we know. So I was curious and looked, and rooms were anywhere from $400 to $500 on a Saturday night in the summer in Atlantic City, and is it price gouging? I don't think so. It's a matter of supply and demand. I did spend some time with some friends and walked through a few casinos on the boardwalk a couple weeks ago. Seemed to be doing average business. Certainly, I'm not telling you anything you don't know. There's more business being done at the marina, I think, than what you're going to find on the boardwalk. But I think if you took a pulse, I think the summer was good. I think it was obviously the heat brought a lot of people down. But we have a lot of work to do, and I'm miffed, Harry, and I don't understand this. It's great that we do these concerts, but why do we do them on the weekends? That I can't figure out.
Because you would want to do them like the Air Show midweek, right? We bring the business when it might
preferably,
not be.
Yeah. But I'm sure there are reasons, and if you want, maybe you ask the mayor or whoever it may be.
Well, one thing is, other than the Belle Biv DeVoe and Vogue, they are not free concerts anymore. So since you are charging for them.
even so, but it just creates think about the stress that it creates on the city. And are you in fact, what do you are you?
You know what I'm going to do? I'm going to drill down on that. I'm going to find out the reason behind that. It could be the date availability of the performers. It could be that since they are paid, they want to draw as many as they can at the best draw time, which would be the weekend. I'm going to find the answer out.
I'd like to get that. Thank you.
And good to be with you, Chuck. Until next week.
Harry, we'll see you then.
Look forward to it. You've been listening to Chuck Malamut. He presents this program weekly, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck. They do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast, subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley, Smith Barney, member SIPC. Dr. Christine is next. Suicide prevention is a topic. And then another doctor, Dr. Newkirk, for 30 minutes thereafter. I'm Hurley in the Morning on behalf of Chuck Malamut. We'll be right back in just a few minutes.